given all that's happened on the macro front and, all that talk about how much the consumption cycle, the consumption recovery would get delayed because of COVID restrictions, and cases are rising once again. So it's a worry whether these restrictions will be put back in place.
I think at this moment might be two major focus that China might be focusing on. First of all, of course, the COVID policy. The changes of the COVID policy status would be very significant towards the China in the upcoming might be half-year development. We can see from the Chinese regulators might be changing their stance from zero COVID policy towards living with the COVID right now. So I think this is very positive to the market and also might bring a lot of upward forces towards the Hong Kong market as well. This is one of the points. And for the second part is that about the property sector, because we also see there are massive forces from the Chinese regulators. They are pushing a lot of the policy might be enhanced banking facilities and also the domestic and also even offshore debt issuance or even equity financing, just to help the property sector to avoid them happening some systematic risks happening in the market. So I think these two part of the Chinese new policy might be helping both China and Hong Kong, and also even might be to the global as well.
Simon, I've got to ask, because I was looking through some of your stock picks and you flagged Tencent as one of your conviction calls, but the thing that would concern me, and I suppose would concern other market participants, if we do see a material wind back when it does come to the US equity markets, in the way in which that a lot of the capital flow comes into companies like Tencent or even any of the other, key big China tech names, is there any risk that if we see a material slowdown in the US, we see it elsewhere, even if China is on a little bit of an uptrend because of the zero COVID, that you're going to see money coming out of equities everywhere? And it's not necessarily going to matter, and especially one that does have, I suppose, a little bit more foreign ownership than others.
Wow, this is a really good question, because we will see that from the United States side, of course, there is a rather major significant point from the United States is the pace of hike might be softening. And we would see from the US market is that most of the capital flow, of course, are going towards the United States market. But then one of the points we have to get in our mind is that from the United States point of view, or even the US stocks, the capital flow might have already been there for around maybe half year already. But then we can see from the Asian market, might be Hong Kong or even the China, we are still undervalued from relatively speaking towards comparing with the United States side. So of course, if we are only talking about the rate hike and the pace of the rate hike have been shortening from the United States market, but then we can see in the Asian market, might be Hong Kong or even China, we are already in the expansionary monetary policy and also even the fiscal policy. So we expect that in terms of the total flow of the equity market might be, we are not talking about newly added funds, but then the funds might be moving from the European or even American market back to the Asian and Hong Kong market. Yeah.
Your other recommendation, of course, is a very popular